Thanks for joining us today on Market Call. I'm Morella Fernandez. Gordon Reid with us on the show, President CEO at Goodreid Investment Counsel. He'll take your questions on U.S. equities. Here's how to reach us. 1-855-326-6266. And if you'd like to send an email, marketcall@bnnbloomberg.ca. Good to see you, Gordon. Thanks for coming in.
You too, Morella.
I'm guessing that you were not at all interested in SpaceX's big debut last week, but did you use the opportunity to pick up other tech that was on a pullback because of SpaceX?
No, but I was interested.
Okay.
But I wasn't a buyer.
Okay.
If you look at the statistics long term on IPOs, you have to start with the premise that when somebody sells something, they think it's at the height of value. And that goes without saying with IPOs. And what tends to happen is that they fall from their offering price. In fact, over the last 20 or 25 years, the average IPO has fallen about 25% within the first year of trading from its IPO price. So even if you like the concept of SpaceX, and certainly it's very intriguing, I think there's probably going to be a better time to take a position.
So would you watch it to take a position sort of later in the year, next year?
Not on the concept alone. We would have to see and do a great deal of work on a valuation basis. Right now, on the surface, it looks incredibly overvalued. But people are buying it because of one thing, and that is Elon Musk. And is he a magician? Perhaps. And he's certainly done some amazing things, but we have to determine how much of that is built into the price and come to some comfort.
Let's talk about the two other big IPOs that are happening later in the year. Do either of those pique your interest? Would you step into them?
Again, based on my previous comments, no. But we own companies that became public within the last generation, and that encompasses our time in managing money. We haven't bought them on an IPO level, but for example, Alphabet, which Google at the time, we now own, but we didn't buy on the IPO. We wanted much more visibility. Same would go with for Facebook, and we're very happy with the point that we got in, because there was that balance between concept or the fundamentals of the company and the valuation and the visibility of the valuation.
Let's talk about the hyper-focus on tech and what you said left other very good companies sort of in the dust right now. Are there certain sectors you're seeing being left behind, or do you find it to be very company-specific?
Within tech or in the market?
No, outside of tech.
Sure, yeah, there's huge bifurcation in the market. You look at healthcare, for example. The last time I was on, I made the point that we're at a 22-year low in terms of the percentage that healthcare makes up of the total market cap of the S&P 500. And I pointed out that who would have guessed, given demographics, the incredible advancements within healthcare to help us all in terms of staying healthier as we get older. Yet the money flow is going elsewhere. That is temporary. We've seen throughout the decades that money flow is slow and gradual, glacial, some would say, but it does flow to value, and that will happen within healthcare. There's industrials that represent great value. I would say in terms of overvaluation, some of the consumer staples represent less opportunity for the price that they're asking in this environment, so I'd stay relatively clear of them.
Okay. Let's take a quick break. We're going to be back with Gordon Reid, Goodreid Investment Counsel, taking your questions on U.S. equities. Here's how to reach us. Back in a moment. Welcome back. Thanks for joining us. We are starting with an email from Sam today. His question for Gordon. He says Netflix has gone and done a lot. Is it a buy at this price? I guess down a lot is what it's supposed to be there. And it has never recovered from the bid for Warner Brothers.
Right. And
I guess there are some other sort of questions about competition moving up in that space. Mm-hmm. Would you buy into Netflix?
We wouldn't. When you look at Netflix, what you see is a company that is largely mature in its most profitable area, that is the North American subscribers. There's about 90 million North American subscribers, and there's not much opportunity. If somebody's going to get a Netflix subscription, they've gotten it incrementally, very, very small growth there. And that's their high margin business. Their growth area is international, but that's a low margin business. So the money that they're making now is really on price increases and tweaks to the model. So they've got a new advertising
Pay more,
model, which is additive. But you put it all in a wrapper and you look at it, they're trading at a fairly demanding multiple into the 40 times earnings range, yet their growth seems to be somewhat restricted. So for us, we wouldn't buy into Netflix. And within your question, you did reference the fact that there's competition coming from elsewhere, and you just look at what trends show, and that is that people are moving away from sort of the big series views more towards a quicker
YouTube shorts kind of
the
thing.
shorts,
Yes.
the shorts, yes. And YouTube, of course, part of Alphabet, which we own, is doing incredibly well, and in terms of streaming is twice the size in terms of usage as Netflix.
Okay. Let's go to the phone lines. And Anita is on the line. She is in Markham, Ontario. Anita, go ahead.
Good afternoon, Marilla, and good afternoon, Gordon. Thank you for taking my call. Gordon, I really enjoy your analysis. I was wondering if you can give your advice on Uber, please. Is it a buy, sell, or hold?
Okay, thank you for the question. Uber has its own business for what it does, Uber Eats and taking people where they need to go. But they're beginning to partner, right, on autonomous driving.
Yes.
Is that going to be a big bonus for them, you think?
Absolutely, absolutely. Because, of course, the entire model is about efficiency. And when you can eliminate one of your huge costs, which is the driver, expand the usage of the capital, which is the car, so cars don't get tired, drivers do. So you have a 24/7 opportunity with that capital investment. There's a lot of opportunity to maximize this type of program. So yes, they've got relationships with Waymo and other self-driving enterprises. They're making big investments there. They're really outside of the mobility. They've got Uber Eats, and they've got freight, and they've got advertising. You have to remember they've got 185 million subscribers to their app. So they've got a captive market there that has an advertising opportunity that they really haven't maxed on. So there's a lot of good opportunity within Uber, and they're growing into their multiples. They were at one point 2-3 years ago, a concept company, a high multiple, lots of promise. Well, they've grown into that promise, and now in terms of financial fundamentals, they're trading at just barely above a market multiple, yet their growth rates into the future are estimated to be much more than the market.
On the flip side, headwinds for that company?
I would say headwinds are probably competition, that whether it's Tesla or some other group captures a bigger piece of the market than is anticipated. But I've always viewed competition as healthy. I mean, you can't avoid it. If you're in a good business, you're going to attract competitors. And if you are a good business, then you're going to maintain or grow your market share, and the market will reward you.
All right, let's go on to the next caller, an email from Dave. He says, could I get Gordon's opinion on Honeywell? I've held it for a number of years, but I'm wondering if there's another company Gordon would recommend. Honeywell is going to split, right?
They are,
which is coming up fairly soon.
Yeah.
Would you hang on until after that split before selling?
Well, the first thing I would say is make sure that your tax advisor has looked at this and you've gotten an opinion on what it might mean, not just in totality, but also as a Canadian taxpayer, if in fact you're Canadian. So that's very important and number one. But from a company standpoint, this is very similar to things we've seen in the past. It rhymes with what happened with UTX, for example, and Raytheon. It rhymes with General Electric and how they split out. And there were a few surprises to those split outs because things happened that weren't anticipated by the market. So when you look at Honeywell, they're splitting out into their aerospace and technology or automation area. I would wait and analyze the companies individually and see whether there's good opportunity there. The market has already weighed in and said that they like the split because Honeywell as a conglomerate has grown in stock price fairly briskly. And
I understand it's harder to evaluate the company when it's that big. It'll be easier to do that once it splits up.
Yes, I would agree with that.
All right. Let's get to the next caller then. Chris is on the line. He's in Delta, BC. Chris, go ahead.
Oh, thank you, Morella. Good morning, Gordon.
Hi, Chris.
Gordon, I call in, and it seems to be my third time the charm on Lennar and the home builders as a whole. Yeah. And I'm wondering to the new Fed chair, Kevin Warsh, if perhaps we are going to now see those lower interest rates, and if the conditions will come together for the home builders as a group to perhaps cyclically rebound from here. And as always, thank you so much for all the commentary you put out, and I encourage everyone to look into the Goodreid.com newsletters that you put in on the member side. Thank you so much. I'll hang up and listen.
Okay, thank you for the comments. I was just reading something about some of the appliance makers now being in trouble because no more houses are being built, and they're having a leg in appliances.
It's a challenge. One of the appliance makers that has had perennial problems is Whirlpool. And for years, they've under-delivered, and it's been a very, very tough environment for them. The home builders have been a little bit more nimble. They've offset some of the higher rates with subsidized rates or mortgages. Obviously, that eats into their margins, but they're really trying to balance the profitability with the volume. Now, with Lennar, interestingly, to Chris's question, Lennar just last week gave an updated outlook of their company, and it wasn't really upbeat. They reduced the number of homes that they're expecting in 2027 to put out from 25,000 down into the low 21, I think, thousand was, if my memory's correct. But it wasn't really positive. I think that Chris's view that cyclically the stars will line up for the home builders is correct. I think that there's a lot of force being exerted to lower interest rates. When that happens, none of us really know, but will it happen? I expect very likely it will. Do you position in Lennar as a home builder? I would say probably not. I think there's better opportunities. On the high end, I would probably point people towards Toll. It's a premium builder. Their average price for a home is over $1 million. Home buyers, 30% put down cash, don't actually mortgage the home. And on the entry side, probably Pulte Homes would be preferable to me to Lennar. Lennar is sort of a mid-market.
How do you spell it, sorry?
Pulte.
P-U-L-T-E?
P-U-L-T-E, yes. Yeah.
Okay.
So I'd probably barbell it based on that, so the high end and the low end entry.
All right. Let's take a quick break then. Back with more of your questions and phone calls and emails. Why don't we come back? Stay tuned. Welcome back. Let's go to an email from Kim. Her question for Gordon Reid is GoDaddy, G-D-D-Y in New York, a buy, sell, or hold. I imagine GoDaddy, you haven't looked at the stock, we'll pull up that line chart in a moment, is like many of these providers where the stock has been held back by concerns about AI just taking it over.
Absolutely. And they're trying to incorporate AI into their business model. Obviously, the market is not convinced, nor am I. I think that there's a lot of risk there. Interestingly, within our own office, one of our staff has been working on our website and making great improvements to the website. This person has really no background in coding, but self-taught themselves in a matter of days using Claude, and very successfully and effectively and cost effectively has made great improvements to our website. So
Proving the point. There you go.
Proving the point, exactly. So I would not be an investor in GoDaddy. I think there's just too much risk that they're going to be made obsolete, and that's of course the risk to a lot of enterprise software, and we see it in the charts and the performance.
Let's go to our next email from Tom. Is it time to buy into Boston Scientific? Looks like it is low enough. We talked about sort of healthcare. This is a more instruments kind of business, isn't it?
Yeah. They do non-invasive heart instrumentation for medical device, the medical device business.
What has held it back? I mean, it's down at $47.
Yeah. What's held it back is that they have lost their organic growth mojo. They did grow at 10 to 12% organically in the past, and the market rewarded it with an outsized multiple, roughly twice what the market was trading at. And they, not so long ago, updated that guidance and said, we're losing share to the likes of Medtronic and J&J and Abbott. And we now project our organic growth to be 6 to 8%. And this is a great lesson in high-price stocks. By price, I don't mean stock price, I mean valuation. So you have a company that's trading at an outsized, a high valuation. Well, it has to live up to it. And if they give you any indication that they're not going to continue into the future or accelerate their growth metrics, there's a lot of air under that valuation. A price to earnings ratio can go from 30 or 40 to 18 to 20 in a heartbeat, and on price of the stock alone, that will have the stock.
Okay.
So that's exactly what's happened to Boston Scientific. I would not step in here. I don't know where the bottom is. Are they going to recover? Are they going to grab more share back? They're trying to, I'm sure, but we have to see evidence of that before we can in any way predict where the bottom of the stock price might be.
So it's not necessarily the space, it is this particular company and where it is at.
Correct.
Okay.
Yeah, if you look at J&J, for example, they're doing quite well, as is Medtronic and Abbott. So no, it's a specific Boston Scientific issue.
Let's go to another email, this one from Jeff. Can I get Gordon's take on McDonald's as a long-term buy? We'll pull up McDonald's, and I'm interested because I know we've talked about this stock before. And we've talked about where the consumer is and what McDonald's has been trying to do to lure people back in. Is it working?
Well, in part it is, but I would say that the headwinds to McDonald's are pretty severe. The consumer is strapped. So, this so-called K-shaped economy
yes.
is very much affecting McDonald's. So the top end of the K is that, say, 20% that is fairly wealthy, has a lot of confidence in their own financial situation, largely because of the stock market doing well and giving them cover. The bottom end, which is like 80% of the economy, are going to talk to you about gas prices and how people are struggling to put food on the table, food inflation, so on, and that's the bulk of McDonald's buyer, and for that reason, it's a challenge. On top of that, you've got a strong move towards better eating, health consciousness, GLP-1 medications that are trying to move people's weight down so they live a healthier life, and that, by the very nature of it, is moving people away from highly processed foods. So personally, I think you just sort of heading into a gale-force wind, and I would pass on the likes of McDonald's.
Okay. Let's go to next caller, Van My's in Toronto with a question. Van My, go ahead.
Well, thank you so much for taking my call. My name is Van My. I would like to asking because I lost almost $200,000 on ETF named XOXX. Is we call the Russian daily semiconductor bear 3 times. So I would like to know, is the ETF or stock or whatever we call it, the name of XXX is still available? Because from $218 US to 40 cents. It's almost lost all my $200,000.
Sorry,
Okay.
do you speak to ETFs?
No.
You don't at all?
No,
Okay.
no.
So, Taiwan Semiconductor is what we were going to talk about, I understood.
Yeah.
Can you give me an outlook for Taiwan Semi?
Well, I think Fan Mai is getting to the core of the issue, and that is the cyclicality of the space. And you know, there in a very cyclical space, you have to get not one thing right, not a good quality company. You have to get a good quality company and the right timing within the life cycle of that good quality company. And that I think is a challenge for any investor. And when things are going well, as they have done in the semiconductor space and the memory space, and when I say done well, that's an understatement. They've done incredibly well. Investors have to be very, very careful because these things end. And most investors think that they're going to see the end and be able to react to it to safeguard their capital. And that just is not the history of investing. You tend to be hurt by these situations. So my advice is if you are going to be involved in the semiconductor space, do it in balance. Make sure that you have rules within your own portfolio as to what percentage this space makes up of your total portfolio. Make sure that you balance these stocks. Use these stocks also as trading vehicles so that they might be good quality companies, but as they get too high, as they go up parabolically, trim them and take a piece off the top. And that will safeguard your total portfolio.
Okay. Let's take a quick break. We're going to be back with Gordon's past picks. We're back in a moment. Stay tuned. Time to go through some past picks from Gordon Reid from July 15th of 2025. This is just under a year ago. At the time, Apple was a pick for you at $209.11 US to $295.58 today, 41% upside, 42% for total return. The announcement of an upgraded Siri is something that you like to keep yourself invested in Apple?
Yes. Yeah. We saw this starting to happen a year ago. We've been an investor in Apple for 20 years. And of course, gone through many cycles. But they kind of went dormant for a few years. Their growth metrics started to flatten out. And we could see almost what was happening, and that is that they were letting other groups do the heavy lifting in terms of large language models, which is their playbook. They've never been the first adopter. They've always taken a more mature situation and then run with it and eventually owned it. And that's what they've done with music. That's what they've done with the tablets. That's what they've done with the phone. We think that that's their playbook with artificial intelligence. Siri, of course, is a disappointment to virtually everybody, but they're saying they're going to advance it, and they're cooperating with Google. They've gotten together with Google to use Gemini in the new advanced or Apple Intelligence product that they're coming out with. Services is a larger and larger piece of their total business, now about 30% of their business, and very, very profitable, about a 75% profit margin on that. So if you look into the short-term future, you're seeing an acceleration of revenues, earnings, cash flow, yet the market has just started to react to that. Over the last year, we've had a good return. We think there's more to come.
Okay, that was Apple from last July. Let's get to your next past pick, CrowdStrike, CRWD on the NASDAQ. So it was $473.28 US last year. to 686.47 today, 45% a return and total return. CrowdStrike cybersecurity.
Yes.
How do you feel about the space right now?
We love the space. These companies are core holdings, and CrowdStrike is the leadership company within the space. From a stock standpoint, it's a very expensive stock. It has an incredibly demanding multiple on it. You can't have a complete portfolio of CrowdStrikes. You have to pick and choose, have one or two in your portfolio. And as I was speaking with the previous caller about the semiconductor area, you have to almost take a bit of a trading approach to it and make sure that your risk controls are really intact. So with CrowdStrike, we bought it 2 years ago in the low 300s, I think 308. Almost immediately, they had an incident with a software patch that did not go well, and the blue screen appeared on computers across the world in July of 2024. Stock sank. We saw that as a one-time issue that would be corrected. We bought more at 228. Stock moved much higher. We sold some at 470. And then just a week and a half, 2 weeks ago, as the stock went parabolic, as you can see on the chart, we sold 25% at $758. So we manage the risk side of this business because of the extreme valuations, but we love the business. We want to be involved, but on our terms.
Okay, good to know, because people had questions about whether that is also a business that's going to be eaten by AI, but clearly you have some positive outlooks for the future. Let's get to your next past pick, which is Mastech MTZ in New York, 171.92 to 371.86. That's U.S. So it's doubled, 116% for return and total return. And they do sort of utilities and communications infrastructure. But can you expand a little bit more on what they do?
Well, they're an engineering firm that does, as you say, work in a variety of industries. They're really growthy areas, as you say, are the communication services, the utilities, pipelines. The gravy on top, I guess, is the data center work that they're getting. Their backlogs are off the charts. They've got a book-to-bill of 1.6, which means they've got orders for 60% more than 1 year's revenues. So very, very strong book-to-bill backlog. And their growth rates are very strong, and their margins are increasing. So it's doubled over the last year, and one would think, well, are they not getting to the point where they are too expensive, that the valuations are too high? We obviously watch this all of the time. We do peer group analysis, and what that tells us is that their valuations are in line with other companies in their sector. So that gives us some comfort. But we also have seen fundamental growth that has not matched, but it has kept up with the stock price, and that gives us some comfort.
How long ago did you get into it? Do you remember?
We got into this stock probably 2.5 years ago,
Okay.
And I just looked at this the other day, and I believe our purchase price was in the low 100s.
On that note, let's take a quick break. We're going to be back with Gordon taking your questions in just a moment. Stay tuned. Welcome back. Thanks for joining us. Let's go to Al on the line in Vancouver with a question. Al, go ahead.
Yes, my question is on PepsiCo. It's been a bit of a disappointment. It's kind of up one day, down the next. Now, there has been some activist investor interest, but I don't see a lot of results. So for PepsiCo, buy, sell, hold, or is Coke the real thing?
Thank you for the question. Are you invested in any of these? Have you invested in these brands before?
Before we have, but this whole space, I talked off the top about consumer staples. These are discretionary stocks, but that you can lump them in. They're just not getting any love. Al mentioned Coke. I would prefer Coke to Pepsi, but to be honest with you, I think there's more fertile ground elsewhere from the consumer discretionary stocks and the staple stocks. We talked earlier about GLP-1s, and Pepsi is a sugary drink, and Frito-Lay, which is their salty snack area, is also not great for the waistline. So they're fighting an uphill battle, and there's just so much happening in the market that is creating opportunity that money flow is just not being attracted to these areas. So my recommendation to Al would be to sell. I think
put your money somewhere else.
Yeah, there are just better opportunities.
Let's go back to the phone lines, and Regan on the line in Calgary with his question. Regan, go ahead.
Hi, Mr. Reid. Thank you so much for taking my call. And my question is more related to Adobe. I'm really sort of looking for something that might be a little bit more undervalued, wondering if I could get your take. Currently, my portfolio is 90% sort of in dividend-paying stocks at this point, just to generate some cash. I am at about 10 to 15% cash right now, so wondering what your take would be. Thank you very much.
Okay, thank you for the question. Adobe recently reported, but again, software stocks are at risk.
Yeah, they are, and Regan, I just think you're trying to force an issue here, because these enterprise software stocks, some of course will survive and do well because they've been beaten down. But Adobe probably was one of the first enterprise stocks that started to suffer because of the threat of AI. We owned Adobe, going back probably 2 years, and we sold it on the basis that AI was a threat. Initially, it was thought that they would benefit from AI because they would utilize AI to enhance their product.
Sure, which they are trying to do.
But what you get into is the fact that you can do it outside of an Adobe subscription. Mm-hmm. So they lose out, and that's exactly the quandary that they're in. Their CEO recently announced that he was leaving. As far as I know, they haven't announced a replacement.
And I think their CFO is also leaving now as well.
Is that right?
That's right.
I didn't know that.
Yes.
But that's a red flag. So to Regan, I would say, look for other areas within the tech area that are undervalued. There are some, and I've got a couple of top picks that are amongst those. And go to those areas as opposed to trying to force it with stocks that have seen price deterioration, because oftentimes they're cheap for a reason.
Let's get to an email from Hillary in Vancouver. She says, could I have your thoughts on Griffin, please? Should I continue to hold, or do you think it will be a range bound? Tell me about Griffin.
Well, Griffin is a specialty manufacturer of doors and specialty doors.
So construction?
Okay. Commercial grade doors, fire doors. We own this stock in our U.S. small cap portfolio. As you can see, it's been a little bit volatile, but over the time that we've owned it, it has done fairly well. Charts go up and to the right are always a good thing. And there you go. You can see that it's done fairly well. And we continue to own it and like it. It's not going to blow your socks off in terms of results, but it is fairly consistent in terms of its fundamental progression.
Okay, so but do you need that stomach for it because of the volatility there? It's not obviously gone sort of in that easy straight line.
It hasn't been overly volatile. It has been somewhat volatile. So, I think. I would have no problem owning it. But again, as with all of our stock picks, especially those that fall into the small cap space, make sure you buy them in balance and measure. In our small cap portfolio, for example, we have about 35 names. In our large cap, we have about 2/3 of that. Mm-hmm. The reason we do is that small cap stocks, by their very nature, are more volatile than large cap stocks. So you offset that company specific volatility with more names, which gives you what we would call in portfolio management theory systemic safety. So safety and size.
Okay, good to know. Let's take a quick break. Going to be back with more of your phone calls for Gordon Reid, Goodreid Investment Counsel, taking your questions on U.S. equities today. Back in a moment. Welcome back. This is an email. It says, I'm rotating out of one of my Canadian banks into a U.S. financial. I'm looking at JP Morgan, but I'm not sure whether to go with the Canadian Silver Deposit or buy it on the New York Stock Exchange inside my RRSP. Alternatively, is there a U.S. financial ETF that you like? So this is Patrick in Salmon Arm. Which way would you go for financials in the U.S.?
In the U.S., we own a lot of the large mega cap stocks.
And you own the stocks.
We own the stocks. We're not interested in trying to neutralize the foreign exchange aspect of the trade. We like the fact that we have some exposure to the U.S. dollar. The U.S. dollar has been strong over time. It is a pricing mechanism of the strongest and biggest economy in the world. So we think it's a benefit, not something that you want to neutralize. That's our view at Goodreid. So we don't hedge, we just buy the stock in the U.S.
Okay.
Canadian banks have done incredibly well. In fact, there's an article on our website that Donnie Moss, our Canadian manager, wrote on Canadian banks very recently that analyzes the performance that they've had versus other benchmarks, including U.S. instruments and the S&P 500. So if people are interested, Goodreid.com, go to Insights, and you'll find that article along with many other. But in the U.S., we own the likes of JP Morgan, we own Citi, we own Bank of America, we own Morgan Stanley, we own Goldman Sachs. So we love the U.S. financials, and the big multi-center banks are right up there.
Let's get to the next email from Janet in Port Hope, Ontario. What's your outlook on Southern Copper?
In the space, that would definitely not be the one we would buy. It's more expensive, and it, in our opinion, is less effective in terms of their operations. We own Freeport-McMoRan, a bigger company. It has both U.S. and international exposure. They produce over 1 million pounds a year out of the U.S., so the largest U.S. producer. But they also have a mine in Indonesia, for example, the Grasberg mine, which is one of the world's largest copper mines, and they produce out of there very effectively. So copper has done well as a commodity.
Do you think it'll still run?
I think it will. We're seeing it very strong today with the cessation of the conflict in the Middle East. Whether that lasts or not, who knows? But copper is definitely reacting positively to that. You can see it's around $6.50, and it's moved up steadily for the last while. And copper companies, of course, are highly leveraged to the price of the commodity. The commodity is in huge demand. If you look at a wide variety of applications, whether it's data centers or electrification of vehicles, the grid, copper is being used more and more and more. And so the demand from a secular standpoint is high and growing. We think it'll double over the next 10 years. So we're a good place to be, and we think Freeport is a good stock to own.
Let's take a quick break. We're going to have some new picks from Gordon when we come back. Stay tuned. Join us tomorrow on Market Call. Keith Richards will be on the show. President, Chief Portfolio Manager at Value Trend Wealth Management. He'll take your questions tomorrow on technical analysis. Let's get to new top picks from Gordon Reid, beginning with Booking Holdings, BKNG, on the NASDAQ, which, I'm going to bring up this term again, software concerns, right? People are going to be worried that AI will now book for them, and they don't need to go through some of these other sites. Why do you like Booking?
We think that concern is overdone. Booking has incorporated AI into their business. They have something called connected travel, which basically upsells you. So you book a trip, Morella, to, I don't know, Spain. And while you're on your trip, they say, hope you're enjoying your trip. Would you have an interest in renting a car? Here's an excursion that we can set you up with. And it's been very, very effective, and it's been done through AI. So some of these firms can incorporate AI. The sell side of the street agrees with us. They think that AI will be a benefit to booking. So that's not a big issue for us. The stock, as you can see, is down somewhat. There are a couple of other concerns that have led it to go down. One is geopolitical concerns. You see the stock is up considerably today.
So people just not traveling.
Well, not traveling, and they're just worried about geopolitical situations. Like, for example, you have a trip to the Middle East planned, or Dubai, or that type of thing. Well, people are canceling; they're just not going or not booking. And finally, the consumer, and people are worried that the consumer is going to stop. What we've seen is that the consumer, if you look at travel, it's the one thing that they want to hang on to because it's experiential. And that, with our society now, is what people crave.
Okay, that's booking. Let's get to your next pick, which is Meta.
Yeah.
Of course, Meta Platforms is Meta on the NASDAQ. Why Meta at this time?
Well, it's 30% off its highs. It's trading at 18 times earnings, so below a market multiple. Yet, our estimates are that it's going to grow in the high teens in terms of percentage growth of EPS over the foreseeable future. So it's severely undervalued, and it's undervalued on the basis that they're spending lots of money on data center development, and people are worried that they're not going to get a good return on their invested dollar. This is a concern across the spectrum of these mega cap companies. There's almost $1 trillion of committed capital to data center development. And until there's some certainty that there's a return coming back to the likes of Meta, I think the market's going to be a little bit subdued.
Yeah.
But this is the time to position. And that's why I bring it up as a top pick, because they're not dumb. They have researched, they know what is likely to happen. And in fact, we are now seeing, as the market moves from large language models being trained to what's called inference, which is the actual application of AI and the productivity that's gained from it, we're seeing that the returns are definitely going to be there. It's just in what size. And we think likely it's going to be a home run.
Let's get to Microsoft, because I've got about a minute left.
Yeah.
And this is another one people have pushed back on because they don't think their AI product is as strong perhaps as others. And they still run software that's embedded everywhere, but people are worried about it.
Yeah, and those were legitimate concerns because they have been collaborating with OpenAI, and OpenAI has kind of fallen back in the race against the likes of Anthropic or Gemini. What has happened in the last few weeks is that Microsoft has renegotiated their deal with OpenAI to give them more latitude, to give them more opportunity to explore other avenues. And we think that's going to open up big things for Microsoft. Azure, which is their cloud offering, is growing at 40% plus. They're second only to AWS, being Amazon's cloud offering. And we think that the software offerings that Microsoft has, whether it's through Windows or you name it, is a perfect launching pad for an AI application. So it's a one platform launching pad. And we think that, they're undervalued. Again, about 30% off their highs.
Okay. You got to leave it there, Gordon. Thanks for coming in. Good to see you.
Nice to see you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.